Hello and welcome to this RCL Wireless webinar. I'm Roberta Prescott. Today's topic is the benefits of infrastructure sharing, and our sponsor is American Tower. I'm joined today by Jennifer Fritzsche. She's Managing Director in Equity Research Department at Wells Fargo Securities, and also by Hess. He's Executive Vice President for International Operation and President for Latin America and EMEA at American Tower. Thank you everyone for joining us today. The time of this webinar is 1 hour with last 15 minutes for questions and answers. Those who want to submit questions, please do anytime using GoToWebinar control panel. Thank you everyone for attending this panel. Jennifer, I would like to ask you for starting your presentation today.
Thank you, Roberta, and thank you for having me. I'm thrilled to be part of today's webinar. Just as background, I've been with Wells Fargo Securities for about 17 years and following the tower sector for most of that time, really since the late 90s. We've seen the good and the bad, and if I knew then, in the late 90s what I knew now, this would probably have been my top picks of all time. We also, just as by also means of background, cover all the carriers. So we cover many of the customers which are on the towers, more on the domestic front, and we follow one Latin American company in NII Holdings. Sticking with the slides, Roberta, if you could start by slide 4, the CTIA wireless survey. I think I'm talking to many people who are aware of the industry, but I just wanted to kind of just frame this in terms of where we are. As you know, based on published CTIA data, we're well over 100% penetration in terms of wireless subs using the entire denominator of the U.S. as the basis for that, calculation. I often joke that my 4-year-old twins don't have a cell phone. So really, when you look at the true addressable penetration, addressable market, the penetration is that much higher. Revenues have continued to grow, but at a slower pace of late. And one of the things, a major part of our thesis is that the model is shifting from a subscriber-driven one to more of an ARPU-driven one. The pie is expanding, but it's really all about usage. And even Verizon, the largest wireless carrier in the U.S., has introduced yet another acronym to the space, ARPA, A-R-P-A, which stands for Average Revenue Per Account. And really, this comes on the heels of their move to tiered pricing this past summer in late June. And really, what their focus is now on is driving more usage within the family or customer unit. We've gone from being a customer that only holds one cell phone to someone being maybe 300% penetrated between an iPhone, a BlackBerry, and a possible tablet. On the bottom left is cell sites. This is really where we get into the heart of the tower discussion. These have continued to increase, and then, as you can see, at a steady pace. One of the things we've always said as it relates to wireless CapEx, if I look back at my marketing data from even 5 or 6 years ago, I and my peers, I should say, often had the path of capital expenditure kind of at a peak and then falling. And as you can see from the chart on this page, on slide 4, that this has really never happened. The below right, bottom right chart of the 4 will show that this is a cumulative number, but if you looked at just individual capital investment, it really has continued at the steady pace. Well, that's bad news for my carriers who are really working on kind of returning free cash flow to investors and justifying the capital they've spent. It's a good news story for the towers because in many cases they're the beneficiary of this. Turning to the next slide, Roberta, it's just continued slice and dice of this CTIA data. On the top left chart, you can see ARPU, average revenue per user, is really driven by data. Voice has become, in my view, just an app. It's very much a commodity-driven business at this point, and I would put texting in that same bucket. I think that with Verizon's move to tiered data plans or shared data plans in late June and AT&T following on its heels in late August, this very much sent the way they approached the pricing very much sent a message about the commodity-ness, if that is such a word, of this revenue segment. If you rewind a year ago, I would be marketing with my company as the carriers, and we'd often get the question of, what about voice? That's a very vulnerable source of revenue for you because anyone can handle it. Text, same thing. Remember, a year ago, carriers like AT&T and Verizon were charging $20 a month for unlimited text for an individual and family. It's a very high margin revenue was a very high margin revenue source for them. And you had what was called kind of over-the-top applications threaten and really make that revenue very vulnerable. Names like, or apps such as WhatsApp and things such as that, even iMessage, Apple iMessage, where if myself and my other friends held an iPhone, every message we sent would be free, iPhone to iPhone. So the dynamics changed, and the carriers knew that it was changing and would change at an aggressive clip. But what they knew that they had the power for, to provide all the things that Cisco and others predict about the growth in wireless data, there's a finite number of carriers or a finite number of players that can actually serve this, and that it serves the pipe to the home, and that's the carriers, AT&T, Verizon being the largest, followed by Sprint, T-Mobile, and others down the road. And from what we've seen is that data is now the key, and driving usage of that data, as I mentioned earlier, is really the way the model's shifting. Remember what I said, the model's shifting from a subscriber-driven one to a usage-driven one, and data is a key part of that. On the chart on the top right, you can see the growth in data. I mean, just a few statistics to throw at you. We have worked with consultants who've said that the average BlackBerry, which now almost seems antiquated, on average use 200 megabytes per day for data. I actually think that's actually even an aggressive number per month. The average iPhone or smartphone device, Android and whatnot, uses 3G device, I should say, uses on average about 1 gig per data. And then when you bring it in a small sample size, but of the iPhone 5 that just was released in late September, the usage, now again, this is, you can assume the more techy part of our segment moved quickly, but is already using on average 2 gigabytes per data per month. You have carriers like AT&T and Verizon say that they have been pleasantly surprised by the rollout, since the rollout of these data plans, that more customers are choosing the higher end plans, data buckets. And I think that all bodes well for towers, as we'll get into. The bottom, it just shows this, this bottom left shows wireless data's percentages of total service. Again, we would expect this dark bar on the bottom left to continue to represent a more meaningful part of the total picture, especially since voice and text have been priced at a much lower price versus historical rates. Finally, smartphone is a percentage of total estimated subs. At the end of the year, it was about 35% in the U.S. This was based on CTIA. Again, this number is we haven't seen the published numbers for December yet for this year, since we haven't ended the year. But we would expect this number to go up dramatically. Just to throw a few metrics at you, AT&T and Sprint both have a penetration of their post-pay base with smartphones well over 60%. T-Mobile is in the high 50s, and Verizon is about 55, 57%. So ironically, the largest carrier in Verizon has the longest runway. You can imagine that most of the devices these days that are sold, 75% plus of the new gross adds or new handset purchases are a smartphone of some kind. So all of this is leading to like the next 4G build. We're in the midst of it. I mean, Verizon has at the last quarter had about 250. This is on the next slide. I'm sorry, Roberta. The next slide shows about 250 million POPs. We expect them to end 2013 with over full nation coverage. AT&T, you can see, doesn't give an exact POP number, but they said they would end this year, 2012, with 150 million POPs covered, and 250 million by the end of the year. At its Analyst Day on November 7th, they talked about further push out of the LTE coverage to about 300 million POPs. So really kind of pushing that coverage out further. Sprint will end this year at about 125 million covered POPs. Sprint obviously has been very active of late, getting a $20 billion investment from SoftBank, which really gives them a greater balance sheet to work from for a national LTE push-out. We expect them to end the year at a similar level with AT&T. And then finally, T-Mobile. T-Mobile's focus has really been on refarming their spectrum and making spectrum that used to be kind of used at edge-type speeds more to HSPA+. LTE is also a very large focus. They expect to end next year with 200 million pops. We just had the chance to travel just last week, actually, with Neville Ray, the CTO of T-Mobile USA, and I will tell you that he really puts a compelling case out there as to the drivers for the Metro PCS deal, which was announced in October, and how that can give them a greater spectrum power. All of this has changed. If we rewind even a year and a half ago, it wouldn't be surprising to see the left and right carrier, Verizon and AT&T, with the bars I've shown here. But the right and the two on the far right, Sprint and T-Mobile, had really very much been companies in transition and pulling back CapEx. Sprint had a host of balance sheet issues they had to work with. And then T-Mobile, since the March 2011 announcement of its merger to T-Mobile, it just kind of flared there for a while and really didn't get back on track, I would say, till that was called off. And even thereafter, I would say a good 6 months thereafter. It wasn't until the later part of this summer, I believe, that they announced a $4 billion investment in their own network. So they really are a much more lively company on the capital front. I know that the topic here today is talking about, the benefits of infrastructure sharing, and this really brings in the towers. My clients are probably different than many clients you all have on the phone. My clients are those that are money managers, that are making investments in the sector. And I often hear things saying, the tower business is kind of where you want to be. I don't like hearing what you're saying about all the capital spend that I'm hearing from AT&T and Verizon. I have no idea how they're going to ever receive a return on that capital. But a way to play the space, it would be an investment in the tower sector. And we couldn't really agree more. It's one of those types of businesses, as I'm sure Hal will get into, that you often think, gosh, could it really be this easy? Because it is just such a great business. And then given all the things I've described earlier, it's in the macro environment for the tower sector, well, kind of negative for most others, is very positive for the space right now. Slide 7 here, Roberta, talks about that this scenario here, the ABCs of the tower industry. The scenario analysis here, you can see page 7. This just shows for someone new to the tower sector what we call the operating leverage that this model has. Specifically, you can see on the top part here the number of tenants per tower. This is a typical, I would say, monopole tower with the ability to hold about 4 tenants per tower. You have one tenant paying an average $1,900 a month. You multiply that by 12, gives an annualized revenue of roughly $23,000 per tower. Then you have the average cost per tower of $815. That's just an all-in number. When people ask me what the cost per tower are, it varies. It varies if they own the land under the tower and therefore have a land lease under the tower. If they own the land under the tower and therefore have to pay real estate taxes, or if they don't own, if they lease the land, paying the landowner. The important thing to remember here is the costs of a tower company are not the costs that Verizon says, okay, American Tower, I'm going to let you run my tower, my cell site, and therefore I want you to maintain that coverage maintain the integrity of that tower or that lease. Or excuse me, that cell site. That's not it at all. In fact, Verizon would be very hesitant to ever let go of that, the integrity of that asset to a third-hand party such as a tower company. Rather, they just want to rent the space on the tower company, on the tower itself, if that makes sense. So when I say the cost per tower, I mean the joke in my world, and I think Hal can give a much better impression than I can, is that there's really not much cost beyond either the taxes or the land lease. The joke in the industry is they need someone to kind of take off the rust of the tower, turn on and off the lights, and mow the lawn. Clearly it's not that simplistic, but I think it's fair to say there's very little incremental cost associated with each tower cell site addition. And this is what we're trying to show toward the top of this chart, is that with one tenant moving up to 3.5 tenants, an average, tower can hold up to four tenants on a typical monopole. You can see the EBITDA margins, which is the second to second to last line here, can exceed like 70%. To put that in perspective, from a carrier side, the best EBITDA margins we have in the industry are those of Verizon's, which are probably in a non-iPhone quarter a mid 40% range. And it's really not only in the U.S. here. Of the carriers I follow, the three tower companies I follow, two have large exposure. One really has large exposure in American Tower, the sponsor of this call, outside the U.S. About a third, just roughly, of their tower portfolio comes from outside the U.S., and a third of their revenue. Latin America really represents one of the most exciting areas of growth for the tower sector. The market is still very much in its infancy, as you can see on slide 8, Roberta, that's what I'm speaking to, with 3G services, some even having not yet launched. The one Latin American company I follow, NII Holdings, has not yet launched 3G service in Brazil. Will be doing so later this year. But even those competitors that have launched, it's still very early stage. Really, of all the Latin American markets, Mexico and Brazil remain the most robust in the area, and much happening in those areas. And like in the U.S., you don't have as much a cry for spectrum shortage, I don't think, but you have spectrum auctions actually happening, but that spectrum for 4G has not yet built out. Like other U.S. carriers, carriers have begun to sell these assets. A lot of the formation of the tower business really came from carriers selling their assets, of their tower assets to tower operators. Because in that same example I gave earlier, if Verizon owns a tower, and you're AT&T, you're probably less likely to rent space on Verizon's tower if you're AT&T than you would be with a third-party neutral host. And so like the U.S., carriers have really begun to sell their tower assets. We have one company, the one I mentioned and actively follow, NII, has recently announced its intention to sell 7,000 towers in these two markets, Mexico and Brazil, and have hired a financial advisor to work with that process. For the most part, I think that, much of the talk, I don't have a slide on this, but I would speak to this, is not just about traditional towers. We're also hearing a lot of new acronyms about DAS, Distributed Antenna Systems, which is a big buzzword in the U.S. today for tower companies and the carriers, because carriers realize they need small cell architecture, heteronets, and other smaller cells to build with this effort. At its Analyst Day in early November, AT&T announced that it would be adding 40,000 small cells, and 1,000 new macro cells, and 1,000 new DAS systems, distributed antenna systems, to help push out further with its network. Turning to slide 9, it's a comp sheet, as we call it, of the three tower companies that I follow. There's three public companies in the space, one of which, American Tower, is a formal REIT. We actually co-cover this with our REIT analyst, Jeff Donnelly, who's not on the phone with me. American Tower, ticker AMT, Crown Castle, ticker CCI, and SBA, ticker SBAC. Our top pick in the tower sector, and I actually just put it as my top pick for 2013 overall, is American Tower. We like this story for numerous reasons. We like the fact that it has a lower leverage ratio or lower debt than many of its peers. We also like the fact that it's not only tied to the U.S. and has a more growthier segment outside the U.S. As mentioned, about a third of their revenue comes from the U.S. outside the U.S., mostly Latin America. In the next few slides, we go through what I call the bull and bear case for each of them. In terms of American Tower, again, we mentioned, you can see with the thesis on slide 10, we believe that the macro environment for this tower sector is very good right now. Right now you hear many cries. I don't need to tell anyone on the phone here this, but for a spectrum crunch. There's been a rise in the smartphone take rate, as we showed, and LTE deployment. I talked to one of the tower companies this morning who began to say that they're not only seeing amendment-type revenue, where cell sites are just added onto their towers, or more equipment is added onto the one current cell site. So in that case, the rent goes from $1,900 to call it $2,200, $2,500. But you're also beginning to see the first signs of cell splitting, which essentially means a whole new cell site is needed to support that demand. Well, the chart in an earlier slide showed the large bar charts for the LTE build. There's much infill build that needs to be done. An example would be maybe they've launched, Verizon, for example, maybe launched the Chicago market but hadn't filled in the corridors or the northern and southern and western suburbs of the city. So I think we're really in the early stage of that happening. And a time to market advantage is seen by the tower, using the tower companies. There's a large, like what we call NIMBA, not in my backyard type mentality. What the tower companies do extremely well is taking on that zoning type issue and taking on that red tape, for lack of a better word. Again, I think this is something Hal probably could speak more to than me, but that is a time saving for the carrier, because you have this real sense of urgency among the 4 national carriers in terms of spending. And I think AT&T at its Analyst Day in early November really upped the ante for the other carriers such as Sprint and T-Mobile to play catch-up. So this is really the first time since the late 90s that we've seen all 4 national carriers spending at such an aggressive clip. Crown Castle, page 11, is also a large tower operator. They are most recently in the news for buying the T-Mobile assets here in the U.S. Crown has a slightly different strategy than AMT or American Tower in that it is more domestic focused. They have small presence in Australia, but really has said they don't want what they consider more risk brought into the model from the international side, and are perfectly content with tapping into the U.S. opportunity. They also acquired a DAS company known as NextG, which prior to them being purchased for about $1 billion was the largest private DAS company in the U.S. So they're really making a bet on this small cell architecture taking place. And then finally, SBA Communications. This is the smallest of the 3, but it also have been acquisitive. Up until recently, they really hadn't done one through TowerCo, which had bought many carrier sites beforehand. We like SBA quite a bit. It reminds me almost of a mini American Tower. It has higher leverage, higher debt, so that in just the macro environment that we're in, separate from the tower companies, I would say that's probably something I'm not as much as comfortable with. So that's kind of my overview. Roberta, why don't I turn it over to Hal, and then I'll be back for questions.
Thank you, Jennifer. To follow on, I thought, just to give a bit of background, I've been with American Tower about 12 years. I have served in a few capacities, but I began working in the international markets in Mexico and Brazil about 10 or 11 years ago. And for the last 6 years, I've been responsible for our businesses in Latin America and Europe, Middle East, and Asia. Africa, or EMEA. What I wanted to do in the next couple of slides is really just go over sort of what the current and recent market activity has been in the tower sector, primarily focusing on transactions between tower companies and the mobile operators. There's obviously been a lot of activity among tower companies, especially in the U.S., where portfolios by small privately held tower companies have been acquired by the 3 public tower companies that Jennifer just overviewed. But really to focus on why we think, or what we're seeing of these transactions and why they're happening and why they've accelerated over the last couple of years, and then talk about sort of what we've seen in terms of transaction structures and how how the market has evolved. So just briefly, in Europe, there's actually been quite a bit of activity, although it's historically has been the most mature market, and there have been very few tower companies in the last 12 months, including a transaction that we did with KPN's affiliate E+ in Germany. There's actually been quite a bit of activity from Telefonica in Spain. KPN has done transactions in the Netherlands and Germany that they've announced, and there was also a transaction in France by a company that I'm sure I will mispronounce the name. It's Ouigas. So there's been more activity. The interesting thing in Europe is historically the tower business has really been broadcast driven, and not broadcast in the sense of passive infrastructure where we actually have a broadcast business where we own the towers. But in Europe it's traditionally been both the passive as well as the active infrastructure, meaning that the tower companies are actually transmitting the signal on behalf of the broadcasters. When you go to Latin America, as Jennifer overviewed, it's been a very active market. You've had Telefonica and Millicom announce transactions in most or many of their markets. We've actually done transactions with Telefonica in all 5 of our markets, Mexico, Brazil, Chile, Peru, and Colombia, as well as a transaction with Millicom's affiliate Tigo in Colombia. But in addition to that, there's been pretty extensive activity by our competitors, and there are several private and publicly held tower companies operating in Latin America now, including SBA, Global Tower Partners, which is a privately held U.S. tower co, and then 2 tower companies that have been started in the last couple of years in Brazil, Grupo Torre Sur and Brazil Towers. And both of those are the latter 2 are private equity backed. And I think that market activity I'll go into in a minute as what is driving that. With respect to Africa, as some of you may know, we're actually operating in 3 countries there, but there have also been transactions or divestitures of tower infrastructure by every major mobile network operator in Africa, with the exception of Vodafone. We've done transactions that have been announced with MTN. We also did a transaction with a company called Celsea in South Africa, but there are 3 fairly good, sizable tower companies operating in Africa who have all done tower transactions with those companies. A company called Helios that many of you may have heard of, Eaton, as well as IHS, which is a publicly held Nigerian tower company. And then finally, just touching on the U.S., I listed here mainly as a contrast, because with the exception of the T-Mobile transaction that Jennifer referred to earlier, there really hasn't been a significant disposition of tower assets by any of the major carriers. Sprint a few years ago, and before that it was the companies that ultimately rolled up into Verizon and AT&T, but there really hasn't been a significant divestiture other than T-Mobile, and that partly reflects the dynamics of that business as well as the maturity of it. And I think especially as they move into data and are managing their networks, the sense I think is that they will outsource as much as they already have, but there are still some assets that they continue. But I don't work in the U.S., so I don't purport to really speak for the activity there. It's just more of an observation. If I could go to the next slide. So one of the questions I think we get a lot from primarily counterparties on transactions is sort of why would we do this? And I think Jennifer has outlined very well on the investment side why people are interested in our business, both in terms of the yield conversion as you add tenants that produce revenue with very little incremental cost, but also as just what I've seen, particularly in the foreign markets, is as the U.S. market and Western Europe have slowed, there's been a significant flight of capital to emerging markets looking for yield. And so when we look at transactions in these markets now, including Europe and the transaction we did recently, it's very competitive, and there's a variety of competitors. The infrastructure funds, which are mainly pension fund owned, there's significant private equity investment in the tower business, as well as the publicly traded towercos and some of the privately held U.S. towercos that I mentioned earlier, which are supplementing the U.S. market or their other core markets with growth in the developing and emerging markets that they're finding. With respect to the carrier side, it really depends on the carrier. I mean, clearly, carriers who have cash flow issues, whether it's because they have a liquidity, current liquidity issue, or don't have access to capital at reasonable prices, in order to fund the network investment that Jennifer was just discussing earlier, it is one way to unlock sort of embedded value in that asset base as a way to generate capital that they can spend in their network. And so it's both liquidity challenged companies who either don't have access to debt or not at a reasonable price, and also a lot of the emerging market foreign-owned telcos are joint ventures or have private shareholders, and they or even the European telcos have made commitments to their shareholders to pay dividends, and so it's a way to manage the cash they need to generate to fulfill those commitments. And then I think one of the biggest things is, and I'm not sure, Jennifer, if you had the metrics in your slides earlier, but if you look at the trading multiples of the towercos vis-a-vis our customers, you can see that there are assets on the balance sheet of the carriers when the carriers are trading at sort of single-digit, mid to high single-digit multiples, depending on the carrier in the market, to the towercos, which are all trading mid-teens to low 20s. And I think the attraction of being able to take those assets and to leverage them into getting value at that kind of multiple on the revenue it produces is one of the reasons people choose to unlock that multiple arbitrage. And then finally, depending on the structure of the transaction, it is a way to manage or even reduce operating costs. There are ways you can structure a sale-leaseback transaction where you lock in the costs going forward that may be either lower or have less variability. And then there, as we've seen mainly in India, the tower companies have been formed as joint ventures among the operators as a way to share the cost of both the existing infrastructure as well as rolling out new technologies. And the latter, we've seen actually quite a bit of activity in Europe in terms of rolling out. Telefonica has been fairly active in joining with other carriers in its various markets and rolling out 3G and 4G technology as a way to share that cost. Roberta, if you could go to the next slide, please. So just to sum up in terms of how the market activity has manifested itself in terms of transaction structures, the typical transaction historically has been a straight asset sale, whether it was structured through a share purchase or otherwise, but typically the towerco will acquire 100% of the passive infrastructure, which is rights to the real estate, including the tower, as well as title to the tower, and all of the other rights and obligations that relate to the passive infrastructure. But as Jennifer noted, typically that does not result in the tower company having operating responsibility for the active infrastructure, sort of the radio equipment that's transmitting the signal. That's evolving in some emerging markets, and there is some active sharing in some markets for different reasons, but typically in most of our markets and clearly in the U.S. that active sharing has not occurred. Another dynamic that has developed in the last couple of years has been joint ventures formed between the operators and the tower companies. We've done this with MTN in Africa as well as with Millicom's subsidiary in Colombia, and this is really driven by the operator's desire to retain an equity interest to share in the upside of the tower business. So as I mentioned earlier, with the operators' shares trading at a multiple that's significantly less than the tower companies, they view this as a way as both unlocking the value in terms of getting access to capital, but also sharing in the future upside of the tower business. And then finally, mainly in India, as I mentioned, there's been sort of the operator-to-operator infrastructure sharing. But in other markets where we operate, there's been a fairly active barter system in some markets, in Brazil in particular, where the operators have shared infrastructure over time on a barter basis, meaning there will either be no cash or nominal cash paid to swap towers on a one-for-one basis. And this is sort of a version of cost sharing, but it's also a way to sort of take advantage of a shared infrastructure without actually having to divest. I will say what we found is typically the tower cos and the independent tower companies are able to maximize the value of the assets simply because as an independent tower company there's not the challenges that you have in a barter transaction where you have to identify a one-for-one swap, or there's clearly you have operators who aren't equipped to deal with maximizing the revenue on the site. It's really more of a cost sharing and a secondary thing. And then finally, in some markets we've seen where the operators have actually retained ownership but have signed a management agreement or a marketing agreement so that they can get the benefits and share in the benefits with the tower operator to market the sites or to outsource the costs and have someone else manage the sites while they retain ownership. So Roberta, I think that's my last slide. So I guess, Jennifer, I don't know if you had anything to add with anything. I sort of referred to a few of your points there, but if you have anything to add, and otherwise I guess we can open up to questions.
Great, thanks, Al. I would just, on the point about public comp valuations, I would note we do have that on slide 9. If you look at the second box to the left, EBITDA multiples, I think that's the multiple Hal was referring to in the mid-teens versus, call it an average of 6 times for the carriers.
Thank you. Sorry, I saw the slide, but my computer screen and eyes sort of combined for me not to be able to make out some of the details.
So with that, Roberta, we could probably take any questions.
So great. Actually, we received a lot of questions. Okay, let's start. The first question I have here, it says, macro-cells networks will be enabled to support the accelerating growth in demand for mobile data service, meaning that HETnets, microcells, femtocells, Wi-Fi, DES, etc. will be an increasingly important component for any operator's network infrastructure. What is the impact of these trends to your clients?
Jennifer, if I can,
Sure.
I'm going to answer by not answering.
Yeah.
I mean, this is primarily a U.S. Dynamic right now, and I do not. I work entirely outside the U.S. So while my colleagues in the U.S., I hear what their experience has been. I'm not comfortable answering. But I assume, Jennifer, in your visits with the companies that you cover, you've probably actually had discussions around this. So I'll defer to you on this one.
Sure. Thanks. Yes, in terms of, wouldn't be in my case clients, but in my case the companies on my active coverage list. It's become a major theme. I mentioned that the AT&T talking about at their analyst day their plan to add 40,000 small cells. AT&T has its own internal DAS system or segment. They announced adding another 1,000 distributed antenna systems. So absolutely, it's for fill-in of the network. I think, if anything, I don't want to make AT&T the poster boy of bad behavior, but I think what Verizon, Sprint, and T-Mobile all saw from AT&T's, getting the iPhone in 2007 and in no way being prepared for what it would do to its network has scared a lot of carriers. And, they really, if they can, spend ahead of that curve. And I say that with caution because I think history's shown it's not going to happen, because every time, the case is like as AT&T would light up more carriers, in New York, they'd see almost, I mean, they say this themselves, almost within an hour, the traffic just kind of double with it. So DAS, small cell, it's very much becoming a major part of the conversation. And domestically, I think to Hal's point, not as much maybe internationally, but domestically, it's absolutely a major part of the thesis. And, in the case of Crown, have very much bet on this thesis with NextG. The one thing I would note that's interesting that I think American Tower really doesn't talk about a lot is that they actually, through their, have the largest IDAS, internal DAS network, but segment of any public tower company. However, that said, they don't really think it's going to be more than 5, I think they've, Hal, you could correct me if I'm wrong, but more than 5% of your combined revenue longer term.
Right. And we have indoor systems in Latin America and Africa as well.
Good.
But as a percentage of total revenue, as you mentioned, it's a very small number.
Okay, our next question is, why the splitting be in the form of small cells and not towers?
Hal, do you want to do that?
Well, I think it's I'll let you add anything. I would say that it depends. It's not necessarily one or the other. That the splitting is a function of a location, so it's in between two macro sites. And this will answer one or two of the other questions I've seen. The reality is, and Jennifer, I'm interested if you're hearing anything differently, but our experience with customers is people still prefer the macro site, i.e. a tower, over about anything else because it's just the most efficient way to get the signal. And there are just some geographies and some dense areas where that, it's not feasible. But so I would say it really starts with the towers, and then the reason small cells become part of the equation is, are there areas in between towers where you either can't put another tower, or where the characteristics of the geography, it just doesn't make any sense. And so my answer to that would be, it's not one or the other. It's really more about where do you need to transmit a signal to address the capacity needs, and that in some instances will be a small cell solution. In some instances will be just adding additional equipment to existing towers.
Right. No, I would agree with what Hal said. I think also from a tower company standpoint, I mean, in that carriers definitely seem to prefer the macro site. And I think from a tower company side, correct me if I'm wrong, Hal, but I think there's still a lot of questions from a tower company standpoint if this is as good a business as the traditional macro site, because the key to that macro site and the beauty of it has been the co-location effort, and in many cases you can't do that with smaller sites, or the jury's still out, I guess I'd say.
Right. I mean, my understanding, again, I won't really speak to what's going on in the U.S., but I do know, interestingly, our indoor distributed antenna systems are multiple carrier systems. So to the extent that same technology on an indoor basis could be used outdoor or with small cell technology. It's not impossible. I think it's, to be honest, it's still sort of in the incubator stage. People are still trying to figure out the most cost-effective way to do it, and that includes the tower companies as well as the operators. And I think people will address it when they can, when a solution is available that makes economic sense. But I really, from an international perspective, outside of Western Europe, it's really not an issue yet because people are still building out coverage sites. The capacity sites or the splitting really is only an issue in the major cities and major urban areas like Sao Paulo, Brazil, or Mexico City, Mexico, where you have such density. And then it's a function of that's where you have just a lot of rooftop and other similar sites to address those capacity needs. And right now, at least, the carriers have been able to address those capacity demands through sort of what I consider a traditional macro site way. And so, Roberta, I don't know. I think that I'm sorry, I don't know. Go ahead, read the next question.
No, I would read the next one. What do you see trends around service providers divesting their towers exits in North America and in Europe, and why?
Well, I see in the question here there's an NA, so I asked, I'm not sure if the caller can clarify whether they mean North America or North Africa. With respect to North America, I have no comment. Jennifer, you may, based on your experience in dealing with carriers. In Europe, as I mentioned, we announced a transaction earlier this month in Germany. So what I see in Europe is there's a tremendous amount of activity, meaning that I'm not sure what's public and what's not, so I won't go into details, but there are probably 5 or 6 current transactions that are at some point in the spectrum of consideration versus actually launching. I think the challenge in Europe is to figure out what the value proposition is, because you have slower growth, and so that has to be compensated some way in terms of the economics in the transaction. In Germany, we were able to get there, but we've looked at other transactions in Europe where we have not been. But I think you'll see continued activity, whether or not the traditional tower companies, as opposed to infrastructure funds or private equity-backed companies, play in that. It just really depends on each transaction.
And if the question was referring to North America,
Okay.
a large amount, I don't know, but I'll answer. A large amount of the carrier deals have been done. One of the questions pointed out was that AT&T Tower Company is the 3rd largest tower company in the U.S. That is indeed true. AT&T has a large amount of towers. I just can't include it in my comp sheet because AT&T does not offer any sort of detail or comments on that segment, which is why my comp sheet only includes the 3 public companies. But, I don't think we're going to see AT&T sell near term. That's just my view, my opinion. There are other carriers such as U.S. Cellular that have had their towers forever, and I know have been pitched left and right by investment bankers to sell them, and they just don't seem willing to do that. But it seems to me like we're going to see less carrier deals, maybe some mom and pops or onesies and twosies, but I don't think any of the big carrier deals, at least near term in the U.S.
Another question. There should be significant opportunity for ringing and installation service for tower companies to offer to operators. Please comment on that.
I guess I would just say that's true. Historically, if you followed our company for the last 12 years, and it's funny, Jennifer and I were talking about this before the call started, the services business is much less predictable, and I think one of the attractions of the tower business has been, in addition to sort of its ability to produce cash flow, in addition and its growth, it's been very predictable. And so I think the challenge to entering into those businesses in a large scale is the margin is lower and they're just less predictable. So I don't see the big tower companies entering into the services business in any significant scale unless those dynamics change.
Good. How much will growth be accommodated by roof rights?
This
I'm
is
not
sort
the
of
expert there.
Yeah, I was going to say this is sort of a tangent off of the small cell. I mean, the answer is significantly depending on the geography. As I mentioned before, in a place like Sao Paulo, Brazil, Mexico City, the bigger cities in Latin America, I think you have a market dynamic where a significant portion of the population lives in the metropolitan area, and that's different than in the U.S. Even though we have large cities, you still have a significant portion of the population that lives in between. And in those cities, if you've ever been to Sao Paulo, there are literally tens of thousands of buildings that you can put antenna on, and that's typically the fastest way to deploy networks. So I would say in markets like that, in that type of geography, the rooftop sites will play a significant role, and they do. I mean, a significant portion of our portfolios in those markets are on rooftops.
Good. Jumping into the benefits of infrastructure sharing, I would ask, will outdoor small cells be shared in the same way as macro towers? If so, where does the sharing stop real estate, backhaul, power, enclosure, antennas, and etc.?
I think I spoke to this earlier. I mean, I would say that it is, in some cases, the jury's still out if this can be really shared. I mean, Hal mentioned the IDAS opportunity to share. I think, the best example I've heard is, I think it was an Extenet system, actually, that it was launched when the Barclay Center was built in New York City, or outside of, where you had 5 DAS players in there. The day it opened its doors, you had the 4 national players and Metro PCS there. So in that case, like in the case of Extenet, that's a real good example of the sharing opportunity that comes with some of these DAS providers. I think for ODAS, outdoor DAS, and smaller kind of picocell, HetNet type service, that's where I would say the jury's still out. I think the key to the Crown deal really working as far as NextG is to have the ability to convince the larger providers, AT&T and Verizon, to kind of share their network and outsource that kind of DAS provider. From my understanding, I could be wrong, but a large part of the inherent customer base they bought with NextG was more on the regional providers, namely like Metro PCS. So if they can get those larger carriers to kind of share on, I think that's key to it. And again, convincing them that the benefits of that network share. I don't know if you have anything to add to that.
I just think in terms of where does it stop, it's in process. I mean, the economic model has to make sense, and determining what service you can offer, what people are willing to pay for, that should drive the decision about, or the consequences of sort of where the sharing starts and stops.
Still on this subject, do you see any regulatory push for spectrum infrastructure sharing?
It comes up quite a bit in Washington, and we hear many of the spectrum kind of proponents say, like, the benefits of sharing. One example that was given to me from a political insider at DC in the telecom circuit is, for example, there's, I think, dedicated spectrum, I couldn't tell you which band, but that's used for when launching rockets and satellites. Obviously, we're not doing that on a daily basis, but maybe, 3 or 4, maybe, I don't know, 5 or 6 times a year. I honestly don't know the answer. But it's relatively underused spectrum in the events that those aren't using it. So, like, some have put the case of, is there a way to share that spectrum? The problem I foresee in that, with the exception of towers, the carriers, in the macro sites they put on tower companies' assets, the carriers, especially AT&T and Verizon, are all about network control at this point. So that's when I think the idea, I always call it like a great whiteboard idea. It's easy to lay out the argument of why it should be workable, but then when you really talk to the carriers and the decision-making process that comes across with those size companies, it gets a little more muddled. So while that has been brought out to the attention, especially as you hear all these cries for spectrum shortage, spectrum crunch, crisis, whatever word you want to use, I think you really run into pushback, because especially the 2 largest carriers, which obviously have very strong lobbyist arms, are all about network control these days. And so that's where I think it runs into issues.
I have here 2 questions related to American Tower. So the first one is, will American Tower be willing to take on SLAs with MNOs and own active infrastructure? And the next one is, American Tower manages rooftops as tower, don't you?
With respect to the second question, yes. We do manage rooftops. With respect to the first question, We currently do not manage active infrastructure, and we would not do that lightly. I mean, it would be a very serious undertaking. It's a different business. It's more complicated. It's unclear what the certainty of the returns are. And as I mentioned before, one of the attractions of the tower model is its predictability and its ability to generate cash flow. And so I don't think that's something that we would necessarily enter into without some very serious thought. I think it depends on market dynamics and how the industry evolves. But right now, at least in the international markets, our focus is on our core business, which has historically been to own and operate the passive infrastructure.
Does a lack of high-capacity internet backhaul constrain tower access growth as much as access spectrum limits?
I could speak just to the tower backhaul. Fiber to the tower, what we call FTT, has been a mini industry up into itself. I mean, the tower carrier, the tower companies don't really play in the dragging the fiber to the tower in many cases, but we have a lot of the RLEX incumbent carriers in those networks, as well as private companies that we have a dialogue with, like including Zayo, and then even the cable operators, which I don't actively follow, but have really made a business up until itself. I don't think that this really inhibits the cell site growth, but I think, in fact, it's just kind of spending ahead of the curve. You know, the laying down of the fiber is a huge part in supporting the demand on the network. I think if Verizon were being totally honest, they would say that it was the lucky miss that they didn't get the iPhone in 2007, even though we know it wasn't GSM or CDMA capable. But because they were able to have a front row seat of what needed to be done ahead of it, and a large part of that was pulling fiber to the tower. So I don't, you know, it helps carriers or tower operators, and that is just one other part of the puzzle to get all the demand, the data to drive this, you know, what seemingly insatiable demand on the network. But I don't think this is an area where tower companies actively want to be a business they want to be in. Hal, I don't know if you'd disagree with that.
No, I agree.
We have, unfortunately, we have just 3 more minutes, and there are several questions regarding American Tower. So, I will just go through that, and then you see what we can answer. So the first one is, does American Tower look to outsource its service and maintenance to the local contractor, or do you have a dedicated workforce?
It depends on the activity, and again, I'm speaking for EMEA and Latin America. We typically outsource some of our work, whether it's the construction or maintenance contracts, and some are local contractors, some are the international vendors that everyone here is familiar with, Ericsson, Huawei, ZTE, NSN, who have local teams that both do, you know, sell equipment as well as services. So we work with them. It really is a function of what resources are available in the market and at what cost. So we do both, depending on the market.
The other one is, do you see American Tower entering the shared backhaul business from its towers?
As I said earlier about managing the active network, I think it's something we will look at and consider, but it's not something that we would do without being very sure that it's incrementally adds to our business in terms of the predictability and its ability to generate cash. But I think it falls in a larger sort of basket, that the reason we look at some of these ancillary businesses, in addition to just owning and operating the passive infrastructure, is to the extent we think providing that service will drive activity at our tower, meaning that it will increase the lease up and make our towers more attractive to the customers, then it's something we will consider doing. But obviously it has to be something that is economically beneficial to the company for us to undertake it. We're not going to do it and lose money just to get additional tenants.
Great. And the last question is for both of you. In international markets, where you see infrastructure sharing is the financial model involving to sharing cost based on MOUs, on MOUs?
On MOUs? I think, Jennifer, if you want to, I'll say something if you want to comment. I mean, to me, the economics, depending on the market, are driving people to consider it as, I think it's less about MOUs than it is about ARPU or ARPA. And I think, again, the dynamics of each market, how competitive it is, what the cost structure is, ultimately, as revenues cease growing as fast and costs continue to grow, it's something that all of the operators, I think, will have to consider in terms of managing their returns.
Yes, I would agree with Hal. I mean, I think minutes of use or MOUs becomes less part of the dialogue these days and really driven by more usage with the main driver there being data. So I feel like that's also been kind of removed. You know, international is not as ahead of us, is not as far as us in terms of the deployment of LTE, certainly, but, you know, we, I think, provide a benchmark of what's to come.
Okay, so our time is it's gone. I'd like to thank you, Jennifer Fritzsche, for joining us today, as well as Hess. And thank you, everyone, for attending our RCR webinar. This webinar will be available within 24 hours. Thank you a lot.
Thank you. Bye.
Thank you.